Okay, first to demonstrate how call options work, I'm going to tell you a little story. And by the way, if calls and puts are old hat to you, then you've already got a leg up. So the method I'm going to teach you afterward will be even easier for you to apply with options. Okay, here we go. So Susie's selling her house for $500,000 in a neighborhood that has a nearby parcel of land that is for sale as well. There are two parties interested in the land. Peter plans to develop the land into a beautiful park and bird sanctuary. And Harry plans to build a low-cost housing development. Now, Sammy comes along and is interested in buying Susie's house for a cash deal, but he has a problem. He won't have the cash available for 3 months. So he's, of course, worried that the house will be sold to someone else in the meantime. So he decides to offer Susie $5,000, or the option premium, right now, if she'll take the house off the market and give him the option. This would be a call option to buy the house for $500,000, which is referred to as the strike price, anytime within the next 3 months, which is the expiration date. Now, if he does not elect to buy the house, Susie keeps the $5,000 premium and Sammy walks away from the deal. If he does elect to buy the house or exercise the option, Susie still gets to keep the $5,000 and he pays her $500,000 for the house. Now, 3 things could happen in this story. In scenario 1, Peter buys the nearby parcel of land. This, of course, will increase the value of Susie's home to, say, $600,000, in which case Sammy will be very happy to exercise his option to buy the house for $500,000. In scenario 2, Harry buys the nearby parcel of land. This, of course, will decrease the value of Susie's home to, say, $400,000, in which case Sammy will not exercise his option to buy at $500,000, and he'll just walk away from the deal having lost only $5,000. Then there's scenario 3, where neither party buys the nearby parcel of land. Susie's house is still worth $500,000, and Sammy can elect to exercise his option to buy the house for $500,000 or not and simply walk away from the deal, losing only $5,000. In effect, Sammy is controlling a $500,000 asset for 3 months for only $5,000. No matter what happens during that time, the most he can lose is $5,000. Susie, on the other hand, is happy to take the $5,000 as she had no guarantee anyone else would buy the house at her asking price, nor did she feel the nearby parcel of land would sell anytime soon. Here's a footnote to the story. Depending on the circumstances, if Susie felt she was likely to attract another buyer in the near term, she would have demanded more than $5,000 from Sammy to take the house off the market for 3 months. Likewise, with call options, the more the underlying asset is perceived to appreciate, the higher the premium demanded by the market for that call option. So now let's define this in trading terms and look at an actual example trade. A call option is a contract between 2 parties to exchange a stock at a strike price by a predetermined date. One party, the buyer of the call, has the right but not an obligation to buy the stock at the strike price by the future date, while the other party, the seller of the call, has the obligation to sell the stock to the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go up to $60, you might buy a $55 call option for, say, 20 cents. If the stock rose to $60, that would allow you to buy the stock at $55 even though it's valued at $60, netting you a $4.80 profit on each share. On the other hand, the person that sold you the call would be obligated to sell you the stock at $55 at a loss of $4.80. If the stock never rises above $55 by expiration date, the call expires worthless, and the call buyer is out 20 cents and the call seller keeps.
Market. If the price goes high, the farmer loses money on that futures contract because she's stuck with it. But that's okay, because now she can sell the rest of her corn, what wasn't in that contract, at the higher price. That offsets her loss in the futures market. If, at harvest time, the price of corn is low, well, that's exactly why she entered the futures market. The low price means her contract makes money, so that profit shields her from the sting of the low price she'll get for the bushels she sells now. The corn cereal company doesn't like those higher prices, and that's why they have a futures contract. They make money on it and can use that profit to cover the higher price of the corn they now need to buy. The futures market serves as a risk management tool. It doesn't maximize profit. Instead, it focuses on balance. And in this way, it keeps your cereal from breaking your weekly shopping budget.
There are 4 key differences between American and European style options. First, all optionable stocks and exchange-traded funds have American-style options, and limited indices such as the S&P 100 also have American-style options. Major broad-based indices such as the S&P 500 have actively traded European-style options. Second, owners can exercise American-style options anytime before the option expires. Owners of European-style options may exercise only at expiration. Third, American index options stop trading at the close of business on the third Friday of the expiration month. European index options stop trading at the close of business on the Thursday before the third Friday. And fourth, the settlement price is the closing price for the expiration period, and it establishes which options are in the money. Any option that is in the money by at least 1 cent on its expiration date is exercised unless the owner requests otherwise. The settlement price of an American option's underlying asset is its regular closing price or the last trade before the market closes on the third Friday. With European options, the settlement price is not published until hours after the market opens, and there is often a change from the previous night's close. That makes holding the position overnight a